Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems that were from Chapter 4, the problems in Group B, right? And just as a quick FYI, again, if you don't understand the theory behind the problem, go back and watch the theory videos. And if you still don't understand something, then feel free to contact an instructor. Now, let me get over to problem, let's see, 4-45. Okay, when it says here the following transactions occurred between Tanaka's and RS Furniture for August. So these are the transactions. And then the requirements say journalize the transactions on the book of Tanaka's and then journalize the transactions on the book of RS Furniture. Now, when I quickly look here, like August 4th, it says Tanaka's purchasing 7,100. Okay, so Tanaka is doing the purchasing, but RS is doing the selling. So from the perspective of RS, these transactions are going to be very similar to the ones that we did for 4-44 because they're doing the selling. This is had sold. So this problem is 4-44 is very much the same as doing RS Furniture. Okay. Now, Tanaka is, and I'm going to write Tanaka up here, and since they're purchasing on account, all right, they're going to owe. So this is from the an accounts payable perspective, and this problem is basically two sides to the same coin, okay? Because RS is making the sales, right? So this is from the perspective of an accounts receivable. Now you can go down through here and do this, do all of these transactions from the perspective of Tanaka, and that's kind of the way it's presented, in the solution manual. I mean, yes, here's Tanaka's books, and here's what these journal entries look like, and here's RS's books, and here's what they look like. Okay, and again, the RS is going to be very, very similar to problem 4-44. So if you're having a little difficulty, go back and rewatch that video, okay? But realize that you're sitting in you're at home and you have this problem in front of you, and you can see these transactions in this order, and it's very easy to sit down and go, okay, well, what's the effect for Tanaka? What's the effect for Tanaka? And then, okay, here's RS. Okay. So you can do that way, and that's the little bit easier way, but the reality is that's not the way it is in the real world. Okay, in the real world, what happens is today is August 4th, and here's the transaction. Tanaka is going to make an entry to their books, and RS is going to make an entry to their books, and then August 5th will go by, August 6th will go by, and August 7th, now there's another transaction, so an entry will have to be made to Tanaka and an entry will be made to RS. Okay. Now, granted, you're not going to be the bookkeeper in both businesses. I mean, you're just going to be, here at, Tanaka and see, here's my entry for August 4th, and then I'll make my entry for August 7th. But what I'm going to try to do here is, no, I'm not going to do it that way. As a matter of fact, what I'm going to do here is I'm not even going to do RS, okay, as I think about it. You have the solutions for RS in the solution manual, and like I said, it's very similar to exercise 44B. So if you don't understand what to do for RS, go back and watch the 44B videos in order to see that how those transactions are being made. So I'm going to just do the Tanaka side here as the accounts payable. For RS, that's an accounts receivable, and from the accounts receivable side, and that's what was the same thing that the perspective in 44. So I'm going to just work on Tanaka, this side, in order to be able to just save a little bit of time, right? So On August 4th here, let me erase a little bit here. And of course, if you don't understand RS's side, and you've watched the 4-44 videos, and you still don't understand, then feel free to contact an instructor. But I find it's just going to be redundant for me to work from that perspective. So on August 4th, Tanaka purchases $7,100 of merchandise and on account, and the terms are 2% 15 FOB shipping, and the goods cost RS Furniture $3,900. So from an RS perspective, you'd make an entry for the sale, and then of course you would make an entry to move it out of inventory. The sale is $7,100. Moving it out of inventory is the cost of goods sold is $3,900. But from Tanaka's perspective, they're buying their furniture for $7,100 on account. So we're not affecting cash. Are we affecting accounts payable or accounts receivable? Yes, we're affecting accounts payable. So my accounts payable is increasing. So I'm going to credit accounts payable for $7,100. And what am I doing? Debits have to equal credits. So what am I doing with it? Well, I'm buying inventory. So I'm going to debit inventory for $7,100. So my entry, and I'm just going to write them kind of like small up here, just like in the other video, so that I can keep track instead of flipping back and forth between slides. So that's the 8-4 entry. On 8-7, Tanaka paid $275 freight bill for delivery of goods. So they're affecting cash. Cash is decreasing. So that's $275. And debits have to equal credits, so I have to debit something else. And so what am I debiting? Well, what am I doing? I'm buying inventory. Okay, this is not a freight bill that's associated with the sale of something. I mean, we're buying it and putting in inventory, so that cost has to be associated with the inventory. So the freight bill goes to inventory. Now remember, from RS's perspective, from the other problem and video, they're making a sale, and if they paid for the freight, that would be an expense to them because revenues have to be matched up with expenses. All right. But for Tanaka, it's just a simple, it gets applied to the inventory. Okay, so let's see here on 8-10. Tanaka returned 1,300 of the inventory purchased on August 4th. So if they're returning it, that means they don't owe as much, and it's 1,300. So, am I affecting cash? No. Am I affecting accounts receivable, accounts payable? Notice that I'm going through that mental process. Sure, I can immediately jump to, in my head, I might quickly jump to purchase, return, and allowance, because I'm purchasing the inventory and I'm returning it. If I'm not thinking through the mental process of how to make a journal entry, I might have a tendency to jump to purchase, return, and allowance. Okay, and this purchase, return, and allowance is a debit, and then I'd credit. No, I'm sorry, I'd credit my accounts payable. Boy, not credit accounts payable. I would debit my accounts payable. I'm crediting purchase, return, and allowance, right? And debit my accounts payable. But, and that's because I'm thinking from the perspective of purchased and returned, okay? And that would be the wrong account, okay? If you go through the mental process, am I affecting cash? No, I'm not. What's the next part of the process? Am I affecting accounts payable and accounts receivable? Yes, I'm affecting accounts payable because I'm decreasing it, and therefore I debit my accounts payable for the 1,300, but now debits have to equal credit, so I'm going to credit something else. Well, what am I going to credit? Well, I'm returning, what I originally purchased. I'm not, and where did it go? It wasn't a purchase. My original entry wasn't to purchases, it was to inventory. So that's why I have to credit inventory for the 1300, okay, instead of purchase return allowance. I'm reversing the original entry. If you're just, if you're sitting in the office on August 10th and, it's being returned, you don't just go, okay, this was something we bought and I'm returning it, so purchase return allowance. No, you have to go back and look at the previous transaction in order to see what accounts were being affected so that you can make the correct journal entry, right? So I have accounts payable here for 1300 and credit my inventory for 1300. All right, so on August 18th, Tanaka's Furniture paid $1,800 of the invoice less the discount. Okay, now they're paying on the invoice, and so the original purchase date was 8/4, and it's 2% 15, so 15 days is 8/19, and then it's net 30, so we're talking about August has 31 days, so that means net 30 is going to be 9/3. The reason why it's 9/3 because 30 days is, you don't just say, oh, 30 days is September 4th because every month has 30 days. No, not every month has 30 days. August has 31, so that means it has to be 1 day less. So that's why the net 30 is September 3rd instead of September 4th. Now it's August 18th. This here is the 1% discount period because, I'm sorry, the 2% discount period. And that was for 15 days, right. 2% for 15 days. And it is now August 18th, so it's falling within the discount period. Now notice that they owe $7,100 on their accounts payable, and Tanaka is paying $1,800 of it. Okay, so if they're paying $1,800 of it, they're reducing their accounts payable, so they're going to debit their accounts payable for $1,800. And since it falls within the discount period, they're able to take a discount. You don't calculate the discount on the full 7,100 like we did in the previous problems. Yeah, that you do in the previous problems because you're paying on the full amount. But in this case here, you take the discount on the amount you're going to pay, okay, of the accounts payable, right? I can't take 7,100 and take 2%, which would be what, $142, and say, oh, I'm taking that as a discount. No, he's only paying 1,800 of the 7,100, so he only gets a discount of 2% on the 1,800, which is $36. Okay, so we're going to credit, inventory for the $36. Okay, and then of course debits have to equal credits, so I'm going to credit my cash for the difference between those two amounts, which gives me $1,764. And so that's how much they're going to pay for that's how much cash they're going to pay in order to pay off $1,800 worth of their accounts payable. So with that entry, my accounts payable here is 1,800, and I'm going to credit my inventory. I'm sorry, inventory for 36, and cash for 1,764. Now, from the last entry here, it says on 8/31, Tanaka's paid the remaining amount owed on the August 4th invoice. Okay, so we have to look at our accounts payable and what do we have in that account. Well, originally I had 7,100, and then I look at my previous entries. I have a debit for 1,300. Okay, and then I also have a debit for 1,800, which is that's 3,100 on the debit side, $7,100 on the credit side. So the difference between the two is 4,000. So I'm going to pay off the accounts payable for 4,000. So that means I have a debit to the AP for 4,000, but they're paying it on August 31st. Right here is 8/31, and that's outside the discount period, so they have to pay the full amount. So they're going to credit their cash for the full $4,000, and that's the final entry for Tanaka. Okay, right now, the only thing that the thought that occurred to me in doing these entries was on this partial payment. If you're doing RS's side for the partial payment of 1,800, right? Remember, it's still going to be a 2% discount, so they're going to debit the sales return allowance account for the $36, and the remainder, the difference between the two of the 1764, that would be to cash, right? And so that, and the remainder goes to the accounts receivable, right? So like I said, the Tanaka's the RS side is very similar to 4-44, but I just want you to realize that when we're doing this August 18th payment here, you have to sit there and calculate it out, and then you're going to use the same amounts, but you're going to choose the appropriate accounts for whatever side of the books you're looking at. Okay, so I hope you understood that. If not, go back again, and like I said, go back and watch 444 and work through RS's side. And then if you work through RS's side and you come back and now you try to do Tanaka's, the accounts payable side, and you put both entries side by date, you'll see that they're basically, where the differences are, and just realize that, accounts receivable, accounts payable are two sides of the same coin. Okay, so you're just kind of like doing the opposite. If you debit this account, you'd credit that account. Just like I'm going to debit accounts receivable and credit accounts payable. And the only other thing that you have to pay attention to is that when you're making the sale, you have to deal with your inventory. So you have these additional entries to take out of inventory and to put the cost of goods sold. Whereas when you're purchasing, you're just putting it into your inventory. Okay. You're not taking it out of inventory and putting it to cost of goods sold, because you're buying it for your inventory. I mean, here's my inventory, okay? And when you buy something, you want to put it into inventory. Well, that's what Tanaka is doing, okay? But from RS's side, either they already purchased and have it in inventory, or they already made it and it's sitting in their inventory. So now what they're doing is they're making the sale to the wholesaler retail, and they're just making their sale, okay? And it's coming from out of inventory. So Tanaka is putting into the inventory, RS has to take it out, but when they make the sale, they have to put it to cost of goods sold, all right? And that's just another way of saying what I've been saying in the last video. So with that, I'm going to stop here and pick up with the next problem in the next video.